What's up, guys? In today's video, I'm going to be comparing SCHG and the S&P 500 because they're pretty similar, but they do have some differences that I'm going to point out. And if we look at my portfolio, it's currently at $52,483.74. And this past week, my portfolio's gone down quite a bit, over 2.2%. It's really gone down $1,193.72, and I only earned $9.59 in dividends. But now, moving on to the topic of the video, I'm going to look at the S&P 500. It's currently at $4,478.03. And year to date, it's up 17.1%, which is a really great return. Now, next up, we have SCHG, which is the Schwab US Large Cap Growth ETF. It's currently at $75.25, and it's up 36.67% year to date, which is an amazing return. And that's more than double than the S&P 500 by a couple percentage points. So that's a great return. Now we're going to go and check out their fact sheets. So we have the S&P 500 ETF, or VOO. So this seeks to track the performance of the S&P 500 index. It's large cap equity. It employs a passively managed full replication strategy, and the fund remains fully invested, and it's got low expenses to minimize net tracking error. And as you can see, the expense ratio right here is 0.03%. That's very low, and that's very good. So they also say about the benchmark, the S&P 500 index is widely recognized benchmark of U.S. stock market performance that's dominated by the stocks of large U.S. companies, and it includes 500 leading companies in leading industries of the U.S. economy. So as we scroll down, and this just gives you an expense ratio comparison. Large cap core funds average around 0.88% for their expense ratio, which is really high. And then large cap core fund average ETFs are around 0.35%. Then if we look at the number of stocks, this ETF has 505 stocks, which represent the S&P 500. So now let's look at their largest holdings. So you have Apple at 7.7%, Microsoft at 6.8%, Alphabet at 3.6%, Amazon at 3.1%, Nvidia at 2.8%, Tesla at 1.9%, Meta at 1.7%, Berkshire Hathaway 1.6%, United Health Group at 1.2%, and ExxonMobil also at 1.2%. Then if we look at the diversification, you see tech at 28.3%, healthcare at 13.4%, financials at 12.4%, consumer discretionary at 10.6%, and then so on with industrials, communication, consumer staples, energy, utilities, materials, and real estate. So the S&P 500 it has a high weighting in tech, but it's still pretty diversified. Now, if we go over to SCHG, so the SCHG, they have an expense ratio of 0.04%. It's a little bit higher than the S&P 500, but it's still really low, so that doesn't matter as much. Now, the fund's goal is to track as closely as possible before fees and expenses the total return of the Dow Jones U.S. Large Cap Growth Total Stock Market Index. It's straightforward, low cost. It can serve as part of the core of a diversified portfolio, and it gives access to large cap U.S. equities. And the stocks are classified as growth based on a number of factors. So if we scroll down, you can see the total holdings right here, 245. So less than half of the holdings is the S&P 500, but 245 still gives you a lot of diversity. Now let's look at the portfolio. So we have the top 10 holdings. You have Apple at 13.92, Microsoft at 11.96, Amazon at 5.66, Nvidia at 5.42, Alphabet at 3.75, Tesla at 3.44, Meta at 3.42, Alphabet at 3.23, United Health Group at 2.32, And then you have a Visa at 1.91. So it's almost the exact same stocks. However, a lot of them are double the percentage. And if they're not double the percentage, they're really close. And then now I want to scroll down to show you the sectors. So you actually have tech at 45.46%, which is a huge weighting. And then everything else just has a lot lower weighting. You have healthcare at 13.47, consumer discretionary at 12.42, communication services at 12.04. Then you have financials, industrials, consumer, staples, materials, energy, real estate, utilities, and so on. So compared to the S&P 500, this one has an insanely large weighting in the tech industry. It's not quite double the S&P 500, but it's pushing it. So now let's look at the back test because this is actually pretty revealing. So we have $1 million, which I'm glad I put that dollar amount. Then we're going to reinvest the dividends and we're going to display income. And we have SCHG and VOO at 100%. So if we scroll down and look at the line graph, you can see with an initial balance of 1 million, SCHG had a final balance of 5.8 million, and VOO was under that by almost 1.2 million at 4.64 million. You can see they actually had pretty close best years. SCHG, their best year is 40.03%, and VOO was 32.39%. But now if we look at the worst year, SCHG was worse at negative 31.8%, and VOO was down 18.19%. Now both of those are really bad, but I'd rather be down, 18% versus almost 32. But so just what this really shows you is that SCHG, you get the highest of highs and you get the lowest of lows. But at the end of the day, SCHG has a much higher return than VOO. So now let's look at the dividends because this is pretty interesting. So as you can see, the VOO is in the red and it has almost double the dividend income of SCHG in 2011 at 20,760 and SCHG at 10,150. But if we scroll over to here, you can see that the dividend income, it's a little inconsistent, but it still remains pretty high. Now, I wanted to point out the year 2022. So VOO is actually almost triple SCHG. So VOO is $64,390, SCHG at $22,774. And then currently VOO is at 33,586 and SCHG is at 13,000. So looking at the total return so like I said, looking at this return, yes, SCHG is much higher than VOO, but after looking at all this data, I think I would actually go with VOO because just for the fact that if I can make $64,000 a year and not have to sell any of my portfolio, I would honestly like to choose that option, even though I could probably sell SCHG and make a lot more money. Just the fact that I can keep my portfolio without having to sell it. That's one of the things that I really like about dividend investing. Plus, VOO has a lot less volatility. And, even in its best year, it still had an amazing return. And in its worst year, it had about it had a normal worst year return.